Okay, let's start. So we started on the chapter 18 income tax last time. And today we will do several things. First, we'll have a recap. And then we will introduce one more topic on this. Income tax is about tax rate. And then we will do some practice. Okay, just to see how to apply what we said in solving income tax problems. So, okay. So last time we talked about accounting income, which is our old income before tax in the income statement, is not exactly the income number we use to determine tax to be paid. So in order for us to determine the taxable income, we start with the accounting income and we adjust for permanent differences between tax rules and accounting rules and timing or temporary differences to get taxable income. And the timing differences is the major challenge in this course, right? So some temporary difference are what we call taxable temporary difference, and some are deductible temporary differences, right? And this, whether it's taxable or it's deductible, to me, is the key concept here. If we get that part straight, we streamline, cut through masters, we make the tax problems a lot easier. Okay, so that's just we'll say taxable temporary differences. So that means this difference is taxable in the future. So this difference will make future taxable income increase. Okay, so that means this, as a result of this difference in the future, there will be more tax to be paid. So therefore, taxable temporary difference, let's say, it will increase future taxable income and therefore increase future tax to be paid. So that means it gives rise to a deferred tax what? Liability or asset? Liability, because that's something we have to pay, right? In contrast, deductible temporary difference, I'm going singular. So that means the difference will be deducted to compute future taxable income, right? So this will decrease, since I'm singular, I think I should use decreases future taxable income. So that will reduce future tax to be paid, and that give rise to why it reduce the future tax to be paid. We paid already, so that give us rise to deferred tax. What? Asset or liability? Asset. Okay, so this is really critical because this is give us like what to report on the balance sheet as deferred tax asset liability. And then in order, remember our asset liability approach, in order to report the correct asset liability, we need to make adjustment. As a result of making those adjustments, we also recognize deferred tax expense or deferred tax benefit on the income statement, right? The whole thing starts here. So let's look at a couple of examples, like what kind of differences, that's abstract, like what difference we're talking about. So we already talked about couple. So one is installment sales. So like it's essentially credit sales, right? It's essentially you make sales, you recognize revenue, but you have not got paid yet, and therefore there is difference between the accounting income and taxable income. Does this give rise to a taxable temporary difference or deductible temporary difference? Taxable, because when the credit sale gets collected, you have to pay a tax on those amounts, right? So the collection in the future will increase taxable income. So this will be taxable temporary difference. And so therefore, we should have a deferred tax liability as a result of this liability. Yes, so that's one. How about unearned revenue? Is it deductible? Yeah, it's kind of the opposite. You get paid first and you have to pay tax right away on the deposit or unearned revenue collected. And in the future, when you recognize revenue, that will increase your accounting income, but you don't pay tax anymore. So you have to deduct this difference. So it's a deductible difference. And that should give rise to deferred tax assets. Okay. And then one more, maybe two more. One, how about the prepaid expense? How about prepaid expense? It is taxable. It's like a little bit like have one more twist to it, because if we just talk money collected, pay tax, that's more direct. Now we're talking about expense. It's a negative number already, right? So if you paid tax, paid for this like insurance policy or rent upfront, you can deduct that amount you paid from your accounting income. Okay, but in the future, when you actually can expense these amounts, you can't deduct from taxable income anymore. You already deducted for that purpose. So you have to add back that amount, right? So it's a taxable temporary difference. And that gives rise to deferred tax liability. Last one. This one was the example we started last class. That is CCA in excess of depreciation. Okay. So CCA, capital cost allowance. Capital cost allowance is the amount it's kind of like a tax depreciation. Okay, so the amount you subtract to determine taxable income. Depreciation here is the accounting depreciation, amount you subtract to determine accounting income. So as we said, this is kind of a quite common, and often this is like one of the significant deferred tax items, because company have lots of PPEs, and so the depreciation and is big expense, right? So usually if you look at the real companies footnote on tax, and they tell you what are the deferred tax caused by, this is the big one. So company, as they're part of a legitimate practice, like tax planning. They want to minimize tax, right? Minimize tax and defer as much as possible. So they deduct as much as possible for capital, for tax purpose. So capital cost allowance often is more than depreciation. And because most of the company grow, so like the reversal seems never happens, like, you know. So what kind of a difference is this? If you deduct more for tax purpose this year than for accounting purpose, it's taxable, because in the future, you will have less to deduct for tax purpose. So future taxable income will be more, right? So this is very similar to the previous one, the prepaid expense, right? Similar, even though it's like a different kind of items. So this will be also taxable temporary difference. And that also gave rise to deferred tax liability. Okay, so that's that. So this is the example. Yeah, that's our review. Any questions? Does it make sense? Does it help? Okay, so I'm fishing for a good thing to say. Okay. So this is the example we did last time. We started out, okay, and I wonder. I think we only did the first year, and we did it in a very methodical way, like lay out all the future reversal. And so I will leave that to a little bit later, because at this point, our tax rate is the same every year, okay? So with knowing how much it's going to be reversed in total, is it sufficient? When the tax rate is different, then you need to know which year the reversal will happen, because the tax rate applied to different years is different, right? So we'll start this. So is it with ABC purchase equipment for 100,000 with zero residual value, 5-year useful life. ABC uses the straight line method for accounting purpose. So this would be the accounting depreciation each year. Okay, 20,000 each year for all 5 years. And then for a tax purpose, it's something similar to the double declining balance. So in other words, it's like an equivalent to say, if you look at the tax rate, it would be for this class tax, CCA rate is 40%. That's what it is, right? Because straight line rate is 1/5 years, that's 20%. And you double it, that's 40%. So like it's equivalent to say for tax purpose, CCA rate is 40%. And that's how it's worded in the tax regulation. Like each, all the assets are like classified into various classes. And then there is a rate for each class. That's how it goes. So that's just say, I don't think anything is 40%, but let's say it's 40%. So therefore, apply that 40%, this will be the CCA, tax depreciation, 40%, right? So you recall when we use double declining balance towards the end, we abandoned the formula because we got to be sure that 100,000 is depreciated over 5 years. So after 4th year, we just like depreciate whatever is left, forget about the formula. Right? Remember that? Yeah. So that's why the last year number is higher than the 4th year number. Okay. So in a way to kind of pay tribute to what the textbook talk about, the carrying amount and the tax base. So I calculate this. So this net book value here is essentially the carrying amount. Okay. And this UCC, undepreciated capital cost, is essentially the tax base. Okay, why it's called a tax base? Because these are at the end of the year, these are the amount yet to be deducted in the future. This provide the base of what you can deduct in the future. Now, this happen to be deductible amount, right? But if it's taxable amount, it will be, this will be the base to pay tax in the future, right? So that this is called the tax base. This is called the carrying amount. Okay, so if you look at this, then we can do at the end of year one. So in the future, there is $80,000 to deduct for accounting purpose, and there is only $60,000 to deduct for tax purpose. So there will be less to deduct in the future. Yes, there will be less to deduct in the future. So that means future taxable income, never mind which year, just future altogether. Future taxable income will be more or less. So everything else is equal, come to PPE. For accounting purpose in the future, all years together, you have 80,000 to deduct. For tax purpose, you have 60,000 to deduct. So to convert future accounting income, we need to add or subtract. So for accounting purpose, you subtract 80,000. For tax purpose, you should subtract 60,000. What would be the adjustment? Plus 20, because you are going to remove that negative 80, right? And only subtract 60. Does that make sense? So therefore, this difference, the difference between carrying amount and the tax base, if you wish to do it that way. But if you don't want to think that way, just use your common sense, right? For tax purpose, you only have 60,000 to deduct. For accounting purpose, you have 80,000 deduct. So start from accounting income to get to your taxable income. You need to add 20,000, right? So this is future taxable. Somebody's taxable difference. I'm just going to. It's all temporary difference. So I'm just going to say this is taxable difference. Okay, so the taxable difference is 20,000. Now, the sign is a problem here because, you know, if your company has more than one temporary difference, some is taxable, some is deductible. Textbook is not consistent. In the example we did it before, it's treated as positive, but then for when they have multiple items, they put everything that's deferred tax liability as a negative number, just because the convention, like a credit is negative number, debit is positive number. So the important thing is don't mix it up. If you use negative number for deferred tax liability, make sure you remember that. So deferred tax asset, and therefore the taxable difference will be positive number, right? So that's the important thing. That doesn't really matter here. However, just to be consistent with what we did the last class, I will have this taxable difference as a negative number, okay? So if I'm looking at multiple temporary differences, I can distinguish them, not mix them up, right? So deferred tax liability will arise from this, right? So we'll have a deferred add 20%, so that should be $4,000. Now, so I'm going to carry through to the very end. That is, well, given this is a new equipment, so there's no deferred tax recognized for this yet, right? So we need to make adjustment to bring the deferred tax liability from 0 to 4,000. And in that adjustment, so that we already have half of that adjusting entry, that is a credit deferred tax liability 4,000. So we need to debit something, right? We need to debit deferred tax expense. Okay, so that in the income statement, we got what we need. That will be a deferred tax expense. And so let me just be kind of careful with the sign. So because this one just have one thing, doesn't matter. But if you want to use this, as a example to solve problem with multiple difference, that's important to keep the sign right. So like if an expense is negative number, you get positive number, means it's a deferred tax benefit, right? So we'll have deferred expense $4,000. So that's for year one. I solved the accounting problem associated with this PPE. Okay, as a result of that, there will be a deferred tax liability on the balance sheet, and there will be a deferred tax expense on the income statement related to this item only. There were other things, obviously. Okay, so now we do the same thing for each of the subsequent years. See, the difference between what we did here and what we did the last class is I know I have deferred, I have taxable difference of 20,000, and it'll be reversed in next 4 years. Okay. However, all the 4 years have a 20% tax rate. So therefore, instead of compute the tax implication each year, I just use this 20% on this 20,000 total, because I know it's not going to be any different, right? But that will change if the tax rate is different. So next thing is year two. At the end of year two, there is still 60,000 to deduct for accounting purpose, but there's only 36 to deduct for accounting purpose. So future taxable income will be more or less than future accounting income. Less. Well, no, future depreciation will be less. Sorry, I was like, future expense will be less for tax purpose. And the, right, like you can only deduct 36,000, and therefore future taxable income will be more. Does that make sense? Right? So this 60 is what you deduct in future for future accounting income. But for tax purpose, you can only deduct 36. So the difference is you have the difference, the adjustment is you have to add the 24,000, right? So therefore you have 24,000 taxable differences, because that's the sign is just our way to keep track. And that means that there is 48,000 deferred tax liability. Now, this time, you already have a balance in this balance sheet account deferred tax liability. The balance was 4,000. So the adjustment require a credit of deferred tax liability of what? 800, not 4,800, only 800. So that means the adjustment is 8,000 increase in deferred tax liability. So the debit side will be deferred tax expense of what? What will be the deferred tax expense? The same amount, right? You credit deferred tax liability 800 and you debit deferred tax expense 800. Okay, so the following year, again, so there's 40,000 left to deduct to the compute accounting income, and there's only 21,600. So again, future taxable income will be more than accounting income, right? So we have deferred taxable difference. This time is 18,400. And so that gives us a deferred at the 20% deferred tax liability 3,680. And since there was already 4,800, so our adjustments we have to reduce. So this is the reversal started. Like the difference, it started with 4,000, get more to 4,800 and gradually reverse, because by the end of that, there'll be no difference, right? So we need to debit deferred tax liability by 1,120, and therefore we need to credit deferred tax benefit. Okay, so let me put it here. So this negative number means it's deferred tax expense, but if it's a positive number, that means it's deferred tax benefit. Okay. Okay, like this one, I could say, well, if it's a negative number, it's deferred tax liability. If it's a positive number, it's deferred tax asset, but we don't have it. Okay, and I could also add here, taxable income is negative. Well, if I have deductible difference, it will be the positive number. Okay, so this, it will be versatile. Okay, the last year, again, you still have more to deduct for accounting purpose and then for tax purpose. So taxable income, again, will be more than accounting income by the amount of 7,640. Okay. At the end of year 4, that future taxable amount is 7,040, because that's the difference you can deduct for year 5. And the deferred tax liability based on that amount is 1,408. Okay. However, the balance in there is already 3,680. So the adjustment is a debit deferred tax liability 2,272. Yes, 2,272. So if you debit deferred tax liability, you would have to credit deferred tax benefit. So again, this is benefit. Okay. And the last year, there's no difference anymore. Future accounting income and taxable income are not going to be any different due to this PPE, due to this equipment, right? Equipment is done. And so the deferred tax liability should be 0. But we have a balance of 1408. So we need to debit deferred tax liability 1408 and the credit deferred tax benefit again 1408. Okay, so this example again, like this is a temporary difference, but this also take 5 years. You see that why the word temporary reversing timing difference is so appropriate, because the difference start from year 1 and grow in year 2 and then started to reverse in year 3 and completely reversed by the end of year 5, right? So by after that, all 100,000 have been deducted for both accounting purposes and for tax purposes. Okay, so let me just do a couple of journal entry we talked about, right? So give us a little bit. So for year 1, it's a debit deferred tax expense of 4,000, and we credit deferred tax liability. So liability went from 0 to 4,000. Okay, now I'm just going to copy this, see if I can put it, be quick. Okay, good. So year 2, we again debited deferred tax expense, but this time it's only $800, and we credit deferred tax liability $800. With this entry now, the balance of the deferred tax liability is 4,800. So okay, so let me make it a little bit smaller so I can fit all the years in. Okay, so year 3, reversal started. Okay, so instead, so our okay, so year 3, we debited deferred tax liability, and the amount we debit is 1,120, and we credit deferred tax benefit by the same amount, 1,120. Okay, so now I'm going to copy this one. Okay, so now I'm going to copy this one to year 4 and year 5. Okay, so year 4, further reversal, it's another 2,272. 2,272. So that's year 4, and year 5, the final balance after that, there's still 1,408, and that's reversed. Maybe I'll give a space for that, just make it look all nice and equally spaced. So by the end of that, deferred tax liability is 0, no more. Okay. Journal entries or adjusting entries, whatever you want to call it. Oh, all the benefit is better stuff wrong. Questions? Make sense? Okay. All right. So that's good. So now we'll just talk about the tax rate. Okay. So far the example is every year have the same tax rate. If future years tax rate is different from current year tax rate, then, you pay tax based on that year's tax, right? So for instance, in this example, we have a taxable future difference. So future, this amount will be added to determine taxable income. How much tax you pay, how much tax liability you carry, depend on when that amount is added to taxable income. And you use the tax rate of that year. So that's the difference, right? So therefore, so how this happened, probably you guys know more because you actually take tax. So if you don't know anything, like you just assume today's tax rate is 20%. No one said anything about change. So let's just assume all the future year would be 20%, right? You do no better trying to make up any different rate, right? So like, however, if the government decide, like when Trump became president in 2016, I think they passed that Job Act or whatever. So they reduced their corporate income tax from 35% to 21%. In effect, in 2018. So now you are still in 2006. I don't know if it's probably 2017. Now you're in 2017. And so this year's tax rate is still 35%. However, you already know future tax rate will be 21%. So when you know, like some of the difference will affect 2018 income tax, the tax effect, you got to use 21%. So that's what it means, right? So that's why this enacted rate or substantively enacted rate, just like more likely than not, that's the thing, right? So let's look at this example again. So we said ABC purchased equipment for $100,000 with $0 residual value, 5-year useful life, blah, blah, blah. And then towards the end, we assume the enacted tax rate is 20% for year 1 through year 2, and 18% for all future years. Okay, so now let's just look at the year 1. From our initial analysis, we already know the difference, the taxable difference. We have a net taxable difference, right? It's a so that's taxable difference. Let's put it in the negative in the bracket, just to be consistent with that, because this is kind of important because each year is different. Is 20,000. We already know that. Yes. Number too weak, but I need to put it all in. So make sure the number is small so it can fit in. Okay, we already know that, right? But this tax difference is going to be reversed gradually over 4 years. Okay, so it's important now the tax rate difference, so layout this way will be necessary. Okay, so in year 2, the deferred tax did not actually there was like a further 4,000, and then if you look at our thing, I think it's changed by 656, and then the next year is 13,360. So next year is 7,040. So let's just put it in, then we and then we explain that, right? So all total is 20,000. So in year 2, there is no reversal. There's no reversal. Actually increase, right? That year CCA again is $4,000 more. So there's no reversal. So I put 4,000, and in year 3, depreciation is more than CCA. So that reverse the 5,600. In year 4, again, depreciation is more than CCA, and the year 5 is the last. I think, did I get the amount right? 11. Oh, yes. Wait a second. I do not have that. Let me see. The first year. Okay, here it is. 20. That's 4,000. That's right. That's 5,600. Oh, it's 11. Yes, 11. 11,360. Yes, it is 11. I just called page right. And the last year is wrong. Yeah, last year is right. 7,000, right? So that's the case. And then with that laid out, that's the hard part. With that laid out, taxable tax rate can be applied to each individual year. So that'll be 20% for year 2, 18% for year 3, year 1, year 2, right? 18% for year 4, 18% for year 5. Okay, so deferred tax liability is calculated at, so this will be 800, 1,008. This is deferred tax liability. And here is 2,045, and here is 1,267, and so our total deferred tax liability is 3,500. Remember, it was 4,000 because every year was 20%. Now with year 1, year 2 being 20% only, and after that is 18%, our tax liability is less. Because when those, right, when those taxable are taxed, now it's at the lower rate. Okay, so that's that. So one more thing before this, let's just look at example here. Revision of future tax rate. So like what if we start out with one rate and then the tax rate changed? Like we actually start this class without any discussion about income tax, just go on our intuition. That is our review question, remember? Tax rate change. So now let's look at it in this context. So the effect of future tax rate changes should be immediately recognized on all deferred tax accounts. Okay, so record as an adjustment to deferred tax expense and the benefit as well. That the adjustment will be deferred tax expense and the benefit. Okay, this little bit of disclosure, I think when you do CPA exam, they focus more on recognition and measurement. They rarely have question focus on disclosure. Okay, rarely have. So this part, I don't know, it has nothing to do with recognition. It has nothing to do with measurement, but it has to do with like a presentation disclosure kind of thing, right? So for IFRS, all deferred tax and non-current. But you know, like part of the reversal will be happening the very next year. So that's current. And under ASPE, if you use this deferred asset liability approach, you need to separate current tax liability from non-current tax liability, current deferred tax asset from non-current tax. So it's kind of that's all you need to know. Okay, that's all you need to know. Like if you see that in the question, it'll be just discussion. You don't need to actually do it for this course, okay? It's a lot to go through. So this is an example. Hotel Corp had a following at the end of 2017. They have 3 million of excess capital cost allowance. Excess of capital cost allowance give rise to deferred tax liability, right? And also, so the deferred tax liability is 900,000 at the 30%. At that time, 2017, tax rate is at 30% for every year. Then the temporary difference is expected to reverse equally in the following 3 years. Now assume new tax rate is enacted from 30 to 25%, effective January 1st, 2019. Now we have to reevaluate deferred tax liability, right? So before every year is 30%. Now for 2018, when the taxable amount is added, you still pay tax on 30%. But for 2019, 2020, when the remainder of taxable amount is added to taxable income, 25% is the tax. So with that, you total deferred tax liability, now it's 800,000. Remember before there was 900,000, right? So you need to make adjustments, okay? You would need to reduce deferred tax liability from 900,000 to 800,000 and credit deferred tax benefit. It's deferred tax benefit because it is a credit. Okay, it's deferred tax liability because it's credit. Okay, so this is something we want to introduce in this course. That's different future tax rate or changes, revision of future tax rate. What's the impact that will affect deferred tax liability or deferred tax asset? Okay, and then in order to adjust deferred tax liability, deferred tax asset, we will recognize deferred tax benefit or deferred tax expense. So now let's look at a problem that kind of put this more than one thing together. So far, we kind of focus one issue at a time. So we look at the problem a little bit more realistic, right? So this is the, this is one of the issues about this course is actually just the information is given in such a way. Lots of times people don't get it right, not because anything you learned or not learned in this course. It's more just like it was so wordy, and then you lost before you actually reach to accounting part, you lost, right? So I don't want to be blamed for that. And so I will, try to simplify that. Okay, so this is a problem in a textbook, actually. So let's read this. Oh, what happened to that? The reading is not on all this time. I think I just, okay. So this is, let's make it a little bit bigger. This is the problem. So let's read through this problem and just go as far as we can this today, right? So is it big enough to see? So Anthony Limited began businesses on January 1st, 2016. At December 31st, 2016, it had a 4,500 balance in deferred tax liability account that pertains to property, plant, and equipment acquired during 2016 at a cost of 900,000. Okay, so this sentence set up like 2016 is done. 2016 is done, and they already did whatever they have to do. They already recorded deferred tax liability. Okay, so we start with the opening balance. That's what it says, because the example we did start with nothing, right? The property, plant, and equipment is being depreciated on straight line basis over 6 years for financial reporting purpose and is a class 8, 20% asset for tax purpose. So that means for tax purpose, you use this accelerated method, use 20% as the rate. Anthony's income before tax for 2017 was 60,000. Anthony follows IFRS and a half-year convention for depreciation. The following items caused only differences between accounting income before income tax and taxable income in 2017. So the year in question is 2017. So like a big part of this chapter to tell us where we start to solve accounting problem. That's the beginning of 2017, right? And all this, it's a lot of calculation. So if you forgot about the half year rule and all that, so it will make it, make this so much more complicated than necessary. So then me just give you, just forget about all that. So basically, I'm just going to explain. So all this part tells us, so this part basically tells us, if you did all the calculation, if I were to make this problem, I would just not to do that. I will just give us taxable temporary difference due to PPE at the end of 2017 is actually, what's the difference? It's $27,000. It's $20,000. I think that's what it is. Yes, it's $27,000. So how do you determine this? You can calculate the depreciation of first year and depreciation of the second year, that's not hard because straight line. And then you calculate book value for this asset. And you can calculate CCA first year, which is 20% with half year rule. And you do CCA for the second year. So that will be 900,000, subtract the CCA of the first year, multiply by 20%. And you determine the UCC. The difference between the book value and UCC turned out to be 27%. The book value is $27,000 more than UCC. So that's actually, the book value of the PPE is $27,000 more than the UCC. That's if you get that part, and it was like a large number, long calculation before you get to that part. And so if you get that part, this is the relevant part. Okay, book value of PPE is 27,000 more than UCC. So I will put it here in case like if after computing the accounting depreciation and CCA of 2016 and 2017, one should arrive that arrived at, is that right? That the book value, or one should conclude, I think probably. I should conclude that the book value of PPE is 27,000 more than the UCC, and therefore taxable, meaning therefore taxable temporary difference due to PPE at the end of 2017 is 27,000. Okay, so that is how that is, I will provide that, so like we won't spend too much time of this course to work that part out. Okay, so that's our interpretation. Now we move on. Okay, in 2017, the company paid 56,250 for rent. Of this amount, 18,750 was expensed in 2017. The other 37,500 will be expensed equally over 2018 and 2019. Okay, accounting periods. The full 56,250 was deducted for tax purposes in 2017. So what does that mean? This is a prepaid expense. So prepaid expense give us a future taxable amount or future deductible amount. Future taxable amount. So this prepaid rent, which is of 37,500, gives rise to a taxable difference, taxable temporary difference, right? And that should give us deferred tax liability. So that's what it is. This is a temporary difference. Next one, Anthony paid 9,000 a year for a membership in a local golf club for the company's president. So this is a permanent difference. Okay, let me see if I can just get a shortcut. Yeah. So membership for golf club is not tax deductible. So this is a permanent difference. So we need to make adjustment for that. Okay, why it's not deductible? It's just not deductible because it's like, you know, not particularly necessary for business purpose. It's a perk for the president. So the tax, the government says it's not deductible. So we're not going to argue with the government. Number 3, Anthony now offers a 1-year warranty on all its merchandise sold. Warranty expense for 2017 was 9,000. Cash payment for 2017 in 2017 for warranty repairs were 4,500. So as we said, like a tax accounting is more like a cash accounting, whereas the financial reporting more accrual accounting. So 9,000 is deducted to compute accounting income, but only the amount paid, only half of that is deducted for taxable income, right? So you have more to deduct in the future, right? When the remaining 4,500 warranty is provided, tax is paid, then you can deduct that from future taxable income. No more warranty expense to deduct anymore in the future, right? From this account, because all 9,000 is already expense. For this particular warranty, no more to expense anymore, but you still have 4,500 to deduct for accounting purpose. So this is what? Taxable or deductible? What's the difference between accounting income and taxable income in the future? Less? Yeah, right? So that this will be a deductible difference of 4,500. Taxable difference give rise to the deferred tax liability, and this will give rise to deferred tax asset. The opposite. Okay, next, meals and entertainment difference. Meal and entertainment expense, only 50% of which are ever tax deductible, or 12,000 for 2017. So it will be like a, which means a permanent difference of 6,000. How about that? Permanent difference 6,000, right? So accounting purpose, you can deduct 12,000. For tax purpose, only you can deduct 6,000. Okay. The maximum allowable CCA was taken in 2017, and then there were no assets disposed for 2017. So this again, like they ask you to compute like what is the book value, what is the UCC, and again, I will just give you a number, and if you want, by all means, try to like verify it. Okay, if you want, try to verify it. So this part, oh, we already did that, right? Yeah, we already did that. We already did that. So that's a we, as discussed above, there is a 27,000 taxable difference, which will result in a deferred tax liability. Okay, so now I think that's all. That's all. So first, calculate the balance in deferred tax asset or deferred tax liability account at December 31st, 2017. Okay, so to do that, we have multiple accounts, right? We have PPE, we have prepaid rent, and we have warranty. So this time it's important that we get our signs correct. So the starting out, say PPE, so that's our item. Okay, so let's make a kind of like a table. So the difference, that's use the same sign, deductible will be positive, and therefore taxable will be taxable will be negative. So these are how we denote difference. That we go even temporary difference. Okay, so that's our first column. And then we go tax rate. Now, in this case, everything it has the same tax rate. So we'll just, we don't even have to bother with the worrying about different tax rate. And then the next one will be deferred tax, consistent with the notation. If it's an asset, we'll show as a positive number. If it's a liability, we will show negative number, liability. Okay, so that's, so let's do this in the next page so it doesn't break up. Okay, so for PPE, what's the difference we had? We talked about 27,000 deferred tax, taxable differences. At a tax rate of 30%, that give us deferred tax liability of 8,100. Okay, the next is prepaid rent. And we also, if you go back to the note slightly early, we have a deferred taxable amount, 37,500. Add 30%, deferred tax liability out of that is 11,250. And again, that's deferred tax liability. The third item is warranty liability. We carry to 4,500. That gives us a deductible difference, 4,500. At a 30% tax rate, so that have deferred tax asset of 1,350. Okay, so the net deferred tax, well, looks like we're going to have a net deferred tax liability because it will have far more deferred tax liability than asset, right? Net deferred tax liability is 18,000. So now we have multiple items and we did all that, we have that. We know balance sheet should be this. However, there was a balance, right? See at the beginning, like at the year 2016, that the CCA is different from depreciation. So as a result of that, there's already a deferred tax liability of 4,500. They already told us, right? So we have to adjust that. We have like a subtract this deferred tax liability at January 1st of 2017. That's the beginning. So this is the deferred tax liability at December 31st, 2017. Okay, so we have to subtract that. That's 4,500. So therefore, increase in deferred tax liability that's also increase in deferred tax liability is deferred tax on the income statement expense, right? So that's also deferred tax expense. That will be 13,500. So they'll have 3 temporary difference we do. Now, luckily, only saying 1 tax rate, right? So one thing at a time. Rome is not built in one day. We will conquer one problem at a time. So this is our computation of deferred tax. So I'm going to highlight it. This is our work. Okay. Calculate income tax payable. I will probably, this is all I can do today. So I'll be happy to get this done, right? So accounting income for the year is what? We're given accounting income is 60,000. Okay, so many differences. So let's do the permanent difference first. So there were how many? I think there were, was there 2 permanent differences? Yeah, the first one is the meal. Golf membership, let's do that. Golf club membership. So the adjustment to that is what? What kind of, do we add or do we subtract? Do we add or do we subtract? We add, right? Because the amount was subtracted to determine that 60,000, you can't subtract for tax purpose. So we'll add that a golf, that's 9,000. Okay, and then the meals. And 50% of the 12,000, that's 6,000, also add. Right? Okay, so that's that. So that total, we need to add 15,000. And then let's look at the temporary difference. The first one is what is it? Just calculate it. PPE. Okay, so access CCA. Okay, so the adjustment, you can do it just to adjust for the difference. We already say that the difference, or we can determine the depreciation of the year. This one, the total difference is 27, we calculate there, but that difference is caused by 2 years. Okay, so the first year is actually, like, we can work backward. The first year is what did we have? 4,500 4,500 was that deferred tax liability, right? So that give rise, oh, here we go, 4,500 deferred tax liability divided by 30%. So that gives us 15, right? And now it's 27,000 difference. So that means the difference increased this year by 12. So I'll calculate that. So I'll calculate this can be calculated as 27,000 total difference. The first year's difference is 4,500 divided by 30%. Right? So that's the difference caused by this year is 12,000. Okay? It's 12,000. So it's 12,000. Does that make sense? Did I go too fast? So we determine the total difference is 27. Just take it as a given. You can verify later. But no, this is 2 years after we had the PPE. The difference already existed at the end of the first year. And all we know about that is that difference gave rise to deferred tax liability of 4,500. So deferred tax liability is the difference times tax rate. So that means that first year, the CCA must be 15,000 more than depreciation. Okay, so that give you 15,000 difference, future taxable difference, give you rise deferred tax liability 4,500. And then that means this year, the difference increased by 12,000 because at the end of the year, the difference is 27,000. Does that make sense? Okay, so just leave it there. Okay, that's that. And then the second difference is what? Is like, oh, prepaid rent. Yeah. Prepaid rent. Okay, so prepaid rent, we can do this time I will do it this way. Like the rent deducted, rent expense deducted is only 1 year, right? So we need to adjust, we put that back in there, 750, and rent paid is deducted for accounting purpose. Rent paid is, what did they say? How much rent was paid? 56,250. 56,250. So the difference is a 37,500 difference. So that's the adjustment. Okay. The last is warranty. For this amount, warranty expense is deducted for accounting purpose, and but for tax purpose should be the cash paid, right? So warranty expense, we subtracted it, it's 9,000. Now we add it back, 9,000. Okay, and we subtract cash paid for warranty. That is the amount should be subtracted for accounting, for tax purpose. So the total adjustment is 4,500. Okay, so adjusting all that from to accounting income, we arrive at the taxable income, which would be 30,000. Okay, 30,000. And at the tax rate of 30%, so we have current income tax. This is also tax payable, same thing. That would be $9,000. Okay, so that's all for today, and we'll finish the whole thing next class before we move on to the last topic. Okay, see you on Thursday. Save that. I will put this on my space.